Welcome back to Alpha Recap. Kristen here, and we've got the market wrap from the first trading day of July. Markets closed the day on the defensive, and as always, if you have questions, you can reach us at stockalpha.ai.
Thanks, Kristen. Happy to break it down. Big picture, headline indexes barely moved, but tech led the pullback, and that created a lot of noise under the surface.
So, what really stands out here is the S&P finished the day down just a hair. The NASDAQ tech-heavy index slid, and small caps were slightly lower too.
Right. To put numbers on that in plain terms, the S&P closed down roughly 0.1%, the NASDAQ 100 fell about 1.5%, and the Russell 2000 was down just under 0.5%.
And the number that really caught our eye: the NASDAQ drop looked bigger than the S&P move.
Exactly. That divergence is the story. A modest S&P change with a sharper NASDAQ pullback signals investors were repricing growth and semiconductor exposure.
I mean, when you step back and look at this, why did tech take a hit while the rest of the market held up?
A few reasons. One, traders were positioning ahead of Friday's June jobs report, so there was caution around anything that could push the Fed's timeline on rates. Two, there were sector-specific headlines. Memory and chip names underperformed after notes about capacity and supply. That pulled the whole tech complex lower.
Right. And the other thing is, we also saw defensive sectors get some love, right?
Yep, utilities and some real estate names outperformed. Utilities got a lift from a nuclear milestone and a big renewables financing announcement. And select REITs rallied on leasing wins and large financings. It was a classic rotation into income and cash flow-oriented sectors, while growth wobbled. To add to that, analysts were reminding the market that rates are still higher than pre-2022 norms. So valuation-sensitive sectors like long-duration growth stocks are still vulnerable to small shifts in economic expectations.
So what really stands out here is that this wasn't a broad market crash, more like a targeted pullback in tech and chips.
Right. Market breadth narrowed. Fewer stocks were carrying the headline stability, while a lot of growth names retraced. That made the NASDAQ's move feel bigger, even though the S&P barely budged.
Honestly, I was a bit surprised by this one.
Yeah, that tracks. The chip complex was a key driver. Names tied to memory and NAND cycles were hammered after reports about inventory and capacity. That pressure showed up across the group and punched Q&Q down more than the rest of the market.
Not a great day for chip stocks.
No, and that has a knock-on effect because chips are central to a lot of larger growth names. When that group slips, it changes the risk calculus for funds concentrated in growth.
Quick question. The article mentions some idiosyncratic moves, like that curiosity-driven rally tied to Elon Musk and a smaller tech name. What was that about?
That was interesting. There was a news thread about reported interest from Elon Musk in elements of a small company's thesis, which briefly lifted trading in narrative-driven names. Those moves were fleeting and didn't offset the big-cap tech weakness, but they do remind you how headline-driven flows can move small names.
Yeah, headlines move crowds fast.
Totally. And then you had autos. General Motors reported a bit of a slowdown in U.S. sales for the quarter, down just over 4%, which is a reminder that consumer durability is mixed in certain sectors.
Right.
Materials and energy were mixed. Some miners rallied on project updates. Renewables got attention via M&A and project deals. And traditional oil and gas mostly followed commodity moves. Shifting to the macro side, the big macro story was the run-up to Friday's payrolls. The labor market print is going to be pivotal for how the Fed talks about policy going forward.
So, what really stands out here is if jobs came in hotter than expected, that could keep rate relief farther out, right?
Exactly. A hotter-than-expected payrolls number would reduce the odds of near-term easing and likely lift real yields, which pressures valuation-sensitive growth stocks. On the flip side, weaker jobs data could revive hopes for earlier rate relief and help risk assets.
I mean, when you step back and look at this, Traders are focusing on more than just headline payrolls, right?
Correct. Participation, hourly earnings, and sector breakdowns matter. Wage growth in particular is what the Fed watches closely because it feeds into inflation. So the subcomponents will probably move markets more than the raw job count.
Right. And the other thing is, Fed chatter after the report could amplify moves.
Yes, any post-data commentary from FOMC officials could tilt sentiment. The market-implied rate path is pretty sensitive to tiny shifts in Fed language, so positioning ahead of the report likely amplified today's tech sensitivity.
Short reactions. Not what anyone expected.
For traders, the technical picture was notable. The Nasdaq move pulled several leaders below short-term moving averages, creating resistance levels on any bounce. When a leadership index moves materially versus the broad market, it can change who's leading next.
So, what really stands out here is the scenario framing the team put forward. Can you walk through the bull, base, and bear cases briefly?
Sure. Bull case. The jobs data is softer than expected, and growth names get a quick relief bounce. Credit spreads tighten, and cyclicals rally. Base case. Data prints in line, trading stays choppy, and leadership stays contested between defensive sectors and growth. Bear case. Payrolls come in stronger, defensive rotation accelerates, tech and semiconductors fall further, and real yields move up.
Yeah, that tracks.
Traders and portfolio managers are likely to stay nimble and favor liquidity until the payrolls and subsequent Fed commentary clarify the near-term policy path.
Okay, quick checklist. What should listeners watch heading into the next session?
First, Friday's payrolls and wage components. Second, any Fed speak after the reports. Third, earnings and updates from chip makers for guidance on inventory and demand. And fourth, sector flows. If utilities and REITs keep attracting money, that confirms defensive rotation. If chips stabilize on constructive guidance, risk appetite could return.
Solid checklist.
One more practical note. Today reminded us that headline indices can mask big dispersion underneath. The S&P barely moved, but the Nasdaq's decline mattered because of concentrated leadership shifts.
Quick reactions.
Right.
Short takeaways, please.
Neutral to slightly bearish near term. Investors were trimming valuation-sensitive exposures ahead of payrolls. If jobs surprise to the upside, expect more pressure on growth. If jobs disappoint, you could see a relief bounce. Keep an eye on chip guidance and sector flows.
Investment disclaimer. This is informational only. It's not personalized investment advice, and it's not a recommendation to buy or sell any security. Analysts note market moves and signals for context.
Exactly. Read filings, consult licensed advisors, and use third-party research for company-level decisions.
Final thoughts?
This was a reminder that leadership can change fast. Today's tape was about positioning into a key macro print and sector-specific headlines in chips. The story next is the payrolls and how the Fed frames it afterward.
Key points recap.
Tech and semiconductors led the pullback. The S&P was essentially flat, while the Nasdaq fell about 1.5%. Utilities and select REITs outperformed. And payrolls this Friday are the big macro catalyst.
If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly, and we'll answer live. For more market analysis and insights, visit stockalpha.ai. Thanks for listening to Alpha Recap. We'll be back after the jobs number with more context.